If you are looking for oil profits in the form of an income stock, ENCC may just be the perfect stock for you. Fasten your seatbelt, folks. This is going to be a good one. The Horizon's Enhanced Income Energy ETF, or the much easier to say ticker of ENCC, is without a doubt a favorite of the community, as they did vote for this deep dive. This is a covered call ETF that has done well over the last 3 years and has even kept its head above water while the energy sector experienced a few, well, not so great moments. ENCC holds some of the biggest oil companies in Canada, and those holdings have created a bit of a synergy with the overall price of oil, well, you know, in the form of West Texas Intermediate, or WTI. In fact, if we plot the relative return on investment of ENCC versus WTI on a graph, we can see that relationship very clearly. Of course, when we do get into the math in a little bit, we will for sure digest some of those numbers. Before we get too deep into this oil well, let's first talk a little bit about covered calls. ENCC does utilize covered calls to enhance that dividend. In a nutshell, they write call options on a certain percentage of the fund. They, of course, then use that money that is generated from the premiums to, well, to pump up that dividend so it looks as nice as it does. On an average month, ENCC does very well with their option strategy with a less than 25% OTM percentage. There's probably people going, what the heck is an OTM percentage? We're not going to worry too much about that. It does stand for out of the money. But what it means in a nutshell is that 75% of their call options are, well, in the money, which means the ETF can make a profit to pay those higher dividends. That's not too shabby. Join today's conversation. Let me know in the comments if you have a favorite covered call ETF. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. I am eager to jump in and see what is beneath the hood in this ETF. Of course, since we are about to dig into the numbers, we will need that one guy who can make your irrational numbers whole again. You know who we're talking about, the one and only Mr. Math. We will start with a little surface data. Their current value at the time of recording was $11.26, and they have an NAV of $11.29. Their net assets, that comes in at $281.06 million, and they do have a beta of 1.85, so they are almost twice as volatile as the market average, or as the price of oil. Their price to earnings ratio, that comes in at 9.70, and they have a 30-day average trading volume of 70,243 units. Looking at their return on equity, that comes in at 22.50%, and their return on assets, that comes in at 11.55%. I do like both of those numbers quite a bit. The surface data does look perfectly fine, so let's peel back another layer and take a look at some of the fund specifics. An ETF, you can definitely expect there to be a management fee, and that does come in at 0.65%. And of course, with the added complexity of a covered call ETF, they do have a little bit more on that management expense ratio, which comes in at 0.81%. These higher fees are typical of covered call funds, as the fund managers must not only pick the basket of stocks, but they're also writing the option contracts on them as well. Let's take a look at their top 5 holdings. We have Cenovus Energy at 9.62%, Suncor Energy at 9.38%, Meg Energy at 9.37%, Imperial Oil at 9.34%, and Canadian Natural Resources at 9.14%. You'll probably notice these numbers are pretty close. That's because of the companies they do hold, they hold an equal weighting. And don't worry, Enbridge is in that list a little bit further down for those of you who are wondering about that. So really, there's nothing wrong with these companies at all. I do like how they have this fund structured. So let's drill down a little deeper and look at their returns. They have a dividend yield of 13.805%. It is a monthly dividend of 13 cents per share. They do not have a payout ratio, or at least they haven't provided one. On their 5-year average dividend increase, not bad. They're up 12.26%. Let's switch over and look at these return on investments. On the 3-year, their price rose from $7.09 to $11.26. That is a return on investment of 58.82%. If we factor in those dividends, we get a total return of 107.73%. I thought it would be fun to see what WTI did in the same time frame. And for 3 years, WTI, the West Texas Intermediate, it comes in at 48.60%. You do have to consider they are down right now, so if oil was up, this might be a completely different story. Overall on the 3-year, this oil ETF has actually outpaced oil in ROI, and then they more than doubled oil on the total return. That is still pretty cool. Let's look at that 1 year. On the 1 year, their price rose from $10.20 to $11.26. That's a return on investment of 10.39%. Total return once we factor in the dividends of 25.69%. On the 1 year, West Texas Intermediate comes in at 21.93%. On the 1 year, oil did outperform on the return on investment, but with that high dividend, ENCC just eked out the crown when we looked at total return. And if we look at the year-to-date, ENCC comes in at 6.83%. Add in their dividends, we get a total return of 10.53%. West Texas Intermediate beats them this time. They come in with 13.46%. So on the year-to-date, WTI wins hands down. But then again, the year is pretty early. Anything can still happen. I do love what I have seen regarding returns. This ETF has produced, and that is not a small thing, considering we had, well, a bear market and energy had some serious slumping in there as well. Okay, it is time to put aside the math, and we're going to ask that big question: what is my final verdict? I am foremost a total return investor, and as many will envision, that means growth stocks with dividends, and usually that is the case. However, when we take an income stock like ENCC and you add some growth to the high dividends, well, you kind of do get a total return stock. I like this ETF a lot, and for now, it really is a great looking option for some income with the total returns that keep me happy. Of course, being a covered call stock, I will still keep my eye on it as it is a little bit riskier. However, with oil being a very underperforming sector, there is a potential blast off, and that would be a fun ride for sure. I do feel this is a good ETF for total return investors, and it could also prove to be very nice on the mid to longer terms. For our passive income investors, this one is a no-brainer. It has the dividends and growth to boot. How can you not like this one? And let's face it, it is a great way to get some oil exposure in your portfolio without owning one of the companies or owning your own oil. Well, gosh, that would be pretty messy, huh? If you are interested in the ETF that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on XEQT. Thank you for watching, and I will see you in the next video.